Tata Steel is among the top Nifty gainers, climbs more than 4% after bullish brokerage notes. Nuvama has upgraded the stock, issued a buy call, raises the target price to 177 rupees a share.
Bharti Airtel climbs on the back of its strong results. Consolidated numbers come in better than estimates, led by Africa business. The India mobile numbers also come in steady.
Tata Motors skids more than 1%, now 0.5% on the back of its results. Despite a quarter that beat estimates, the management has issued a cautious outlook for JLR in the coming quarter. Kotak Institutional Equities and Jefferies are bearish on the stock.
And Aditya Birla Capital rises close to around 5% after bullish brokerage notes. Macquarie issues an outperform call with the target price of 260 rupees, while Morgan Stanley issues an overweight rating with the target of around 250 rupees a share. Both cite a steady quarter as the key reasons.
A bunch of stocks in focus on the back of their results. We have Max Financial, Dalmia Bharat, as well as Garden Reach Shipbuilders on the back of their earnings, gaining big. Garden Reach Shipbuilders up 17%.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam, and we're getting used to our favorite color yet again. We have green that should come up for you on the top of your screen. The Nifty has bounced back 150 points. The Nifty Bank not doing that great today. It's a bit of an underperformer, but the breadth of the market is good. So that's why your portfolio must be feeling quite good. Mangalam.
2 days in a row, over 2,000 stocks in the green. That looks fairly good. The important part, however, where we go from here on, because this 24,700 to 24,800 could be a bit of a supply zone. But if we sustain above these levels, then there are a lot of shorts in the system. Maybe ahead of weekly options expiry tomorrow, we may see some short covering. But let's talk about individual stocks. Ask Automotive. That's the stock on our radar. Reported a good quarter, posted strong revenue growth. Kuldeep Singh Rathi, who's the chairman and managing director of the company, joins in now to detail the quarter gone by, but more importantly, talk about the year that lies ahead. Thanks a lot, Mr. Rathi, for joining in. Just a two-part question. One, what's your outlook for FY26 when it comes to revenues and margins? And secondly, you were looking to increase your contribution coming from electric vehicles and exports. Where do those numbers stand right now? What's the prognosis for next year?
Good morning, Mangalam. This year, we have done well. As you see that the profit has grown by 43%, the year profit. And as you asked about the next year, so next year also looks very, very positive. And why I am positive on the two-wheeler is that we have still not reached the numbers that we achieved in 18-19. Of course, we were very close to this. So I see a good year ahead, and especially in view of all the macroeconomic indicators, that is the low interest rates, the tax cuts, which are going to benefit the two-wheeler industry, the forecast of the good monsoon, because a good monsoon, the agriculture sector, will be good, and from where the two-wheeler demands is going to come. So next year, we again expect the numbers revenue growth to be into the mid-teens, as always. And we'll outperform the industry, which have been doing for the last 30 years. And the future looks very, very bright.
All right. Hi, Mr. Rathi. You're sounding quite optimistic about prospects. Give us a few more details. Could you tell us what proportion of your revenue comes in from EV, if you could help us out with that? And earlier, you were aiming at scaling up exports as well. But the globe itself has moved into a bit of a tizzy. So for the coming year, FY26, what kind of a revenue contribution can you get from exports, yes. EV and exports?
Good morning, Nigel. Yes, you're right. The EV sector has not picked up as yet. And as you will see, the EV share of the whole market, two-wheeler market, is less than 5%. It has not even crossed that. So our share is also around 4.7% or so. So it's we are moving as per the share of the EV sector. As you know that we are OEM to the 80% of the organized EV market. So we'll grow as per the growth of the industry in the EV side. On the export side, we have done a lot of groundwork. We wish to grow further ahead, but as you have rightly said, the geopolitical situation has not been good. The tariff uncertainties also came, but still we have held the ground But this year, we can see an appreciable improvement in the exports as one of the customers, one new order of 75 crores is in the pipeline, which we hope that it will go as per the plans.
And what would that take your overall export contribution to this year? Where does it stand right now?
We are at about 4.5, around 4.5%. And next year, we will definitely, hopefully improve it.
To what, sir? Because exports, I remember you had said, are better margins for you.
We are from 147 crore. Well, our aim is to go to 250 crores.
And what does that do to your margins?
Margins are always, exports are always good.
No, overall margins for the next year, what's your target?
Overall margins, we will certainly improve our overall margins by 150 basis points from this. So we'll be, but we are aiming to achieve 14% EBITDA margins.
Okay, and if I got that number correctly, exports moved from around 147 crores to 250 crores. Is that correct?
Yes, please. Yes, please.
Okay, tell us a little bit more about the Karoli plant. You were looking at ramping up that, right? So what is the current utilization levels? How much are you factoring in terms of a contribution from here?
Karoli plant, continuously the investments are also going on, and the capacity utilization also remains at around 50%. And it is totally into the cash profits, Karoli plant. And after that also, we made one more investment. And that investment was in the Bangalore plant, which we commissioned on 14th January. So all the necessary QAVs have happened, and we are confident that from this quarter, even that plant will become EBITDA positive.
So Karoli plant, I remember the last time you joined us, you said at peak could do revenues of close to around 300 crores. Is that correct?
No. I said ultimately it will go to more than 1,000 crores.
Okay.
But it will need further investments, which will be making this year also about around 200 crores more investment will make. But already it has achieved 500 crores.
Okay. What is your current, your CAPEX plan for this year, sir?
CAPEX plan, since I am an optimist, as you have seen, we'll be spending about 450 crores. And mostly this 450 crores will come from the cash generation that we'll make. Okay,
all right. What is the optimist in you telling you about your own stock price? The promoter entity still holds around 79% in the company. Yes. You have 4% to come down to the minimum public shareholding norms. Does it happen? Yeah.
We have 18 months left for that. We are not in a hurry,
Because you're in no hurry.
No hurry. We don't need the money. We are a very cash-rich company.
You were also looking to, increase your contribution coming in from non-two-wheelers, commercial vehicles and passenger vehicles. Where does that number stand at right now? Have you won any client orders here?
Yes. We have got the orders, and that through Tier 1, we are not directly into the passenger vehicle, but we are through Tier 1, and that business is slowly and steadily growing.
All right.
So where do you expect this to go from here?
This will keep on increasing because the focus is there. This will keep on increasing. And the idea is to overall grow the business in the double digit, That's always the idea, because then only there is more capacity utilization, you get more economies of scale, and that's how the margin improvement is there.
All right, take that point. Thanks a lot, Mr. Rathi, for joining in and giving us your views on the year that is ahead. You expect better exports revenue coming in. EVs will grow in line with the industry. But for you overall, mid-teens revenue growth with margin aspiration towards 14% is what the street will take away from this conversation. Take a short break. On the other side, we have another management joining in. Puneet Lal, by the way, Vice Chairman of Anup Engineering, joins in to discuss the quarter gone by.
Welcome back. You're tuned into Chartbusters here on CNBC-TV18. Well, keep an eye out on the screen. Some of these defense stocks are moving quite well. Paras Defense is up and about. You have DCX Systems as well, has moved to the high point of the day. Now it's up, I think, close to around 5% as we speak on rather large volumes. A big move out there. And KPI Green as well. In a matter of, I think, the last few trading sessions, the stock is up more than 20%, corrected big time from the top. But I think the street likes those numbers and also likes the cash flows. Explains why that one is still holding well in the green. Well, I think next up, though, we could Get in our next management, we have Anup Engineering. The company posted actually a strong quarter in the past, in quarter 4. Profitability, though, a little bit of a disappointment. The gross margins did contract a little bit. To help us out with the way ahead, we're joined by Mr. Puneet Lalbhai, the Vice Chairman of Anup Engineering. Hi, Puneet. Thanks a lot for joining in. And let's talk about business first in terms of a guidance for FY26. What kind of numbers are you looking at in terms of margins? I think it was in that vicinity of around 20% is what you were targeting, while revenue growth of around 25%. You're confident you can get to those numbers?
Yes. Usually we have, a very strong order book going into the year. And this year is no different. We already have about 80% of the order book locked in. And we are now looking at short lead time orders to ensure that our growth will be above 25%, and we should be in with that 20% plus EBITDA margin. So things are on track for next year.
All right, 25% growth with EBITDA margins upwards of 20%. So those are from the income statement outlook. Puneet, just wanted to know what happened to the trade receivables? Because I'm looking at your annual cash flow statement and it's actually turned negative from for this year, cash flow from operations, down from 170 crores to a negative 8 crores. And that's because trade receivables have increased by about 140 crores. If you could give us a sense on what propelled this and what's the outlook here in terms of receivables and your working capital days?
We expect the trade receivables to normalize in Q2. This is on account of one very large order that has a request for delay from the customer's end because their site is not quite ready yet. So we are holding that order, and the majority of the trade receivable impact is because of that. I would not be concerned about that. I think it will normalize by Q2.
And it's a solvent customer, right? There's nothing really to worry about, or one shouldn't worry about this going into bad debt or anything, right? It's just a near-term liquidity.
No, not at all. No, not at all.
You want to quantify this client's exposure?
I beg your pardon?
You want to quantify this client's exposure?
It's about a 200 crore order, of which 90 crores has been produced and billed, of which a good chunk of money has also been received. So everything is current. It's just about a 3-month delay after the jobs have reached quite an advanced stage. So I would not say that there is any risk of any bad debt on this customer. It's a very blue chip customer, and
Right.
As soon as the jobs are shipped out, our receivables should normalize.
Got that. So that assuages some of the concerns that the street had this time around. So 25% revenue growth, 20% margins, receivables get fixed in the next couple of months. What about order inflow? What's your guidance for FY26? Where does your order book currently stand, and how many orders do you expect to get over the next 12 months?
So our current order book stands at around 750 crores. We delivered in FY26. We are under discussion for some large orders that should get finalized over the next 3 to 4 months. And after those orders get finalized, we should be able to cross that 25% growth rate. It's been an extremely challenging environment. In India, post-elections, there were a couple of quarters where there has been very low order inquiry bank from the PSU sector, especially, and with elections in the US and the tariff uncertainty, there has been somewhat of a holdback from the US as well. But the good news is that India projects are coming back on stream, and we are just maybe 1 or 2 inquiries away from fulfilling what we need to do in the next financial year.
Well, that's right. And Mr. Trump is making things even more exciting with regard to the US. So my question to you is, how do you see your revenue mix pan out? Because as we speak, as of the last year, exports were a greater quantum. So what is the outlook out of this growth that you're talking about for the coming year? How much of it will be exports? And what is your current exposure to the United States?
So we would be about 50% exports even in the next financial year. And the current exposure to the US would be between 20 and 30% of
20
the
and 30
export volumes.
of the exports. So overall, it will be around 10 to 15%.
Correct.
All right. And what is the margin difference between the two, domestic and exports?
Exports are usually a couple of percentage point higher in margin, but it really depends. It really depends on the product mix. It depends on the criticality of raw material, the criticality of the work content. So generally, as a rule, a couple of percentage points higher in exports, but that's just going on past averages. It can all change depending on what sort of orders we click. Right now, exports are about 2% higher.
Got it. And, you spoke about product mix. We saw a big jump in your vessels business, nearly 5 times, a low base. Towers and reactors grew by 46% as well, smaller base. You had health exchangers, which is your major revenue driver. That grew just about 2%. So what's your prognosis for all these individual products? How are they likely to do in the next year? And even the Mabel acquisition, right? It's been 1 year so far. What's the performance this year been? And next year, I believe, you will enjoy the benefits of synergies.
Absolutely. So I think the increase in reactors is because our Kheda plant has completed phase 1. Kheda plant is a greenfield facility where we have 20-meter high bays, where we have very heavy lifting capacity. So that facility is very amenable to large reactors, which we were not able to do through our Automotive plant. So the coming on stream of Kheda is the reason why you are seeing the jump in reactors and vessels, and that is according to plan. Kheda phase 2 is also in advanced stages, so we should be completing Kheda phase 2 sometime in Q3. So after that, we expect that the steady state order book, considering both Kheda and Automotive, should be about 60% vessels and reactors and about 40% heat exchangers. And yes, Mabel has done well. We posted about 43 crores of revenue from Mabel this year. And there is a lot of headroom to grow. The other interesting thing about Mabel is that the order cycle there, order to delivery cycle, is much lower. So we can turn around equipment in 6 months.
All right, very quickly, before we let you go, the Kheda plant, it adds to your capacity by around 20%?
Yes, and I think after Kheda phase 2, which will be completed in Q3, our overall capacity should reach about 1,200 crores.
All right. And I'm sorry, I didn't get the Mabel guidance. This year you did 46 crores. Next year, what is your target?
We should be upwards of 70-80 crores next year.
And EBITDA break-even and margin synergies enjoying, right?
Absolutely. That's all part of the overall 20% guidance.
Okay, all right, Puneet, appreciate you joining in, giving us all of those details. Wishing you all the best for FY26. We've taken a lot of numbers from you. We'll hold you to that guidance all through the year. Thanks a lot for joining in. Well, for the time being, let's slip into a short break. As we do that, here's some good news for all our viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates. All of this at your fingertips. Just download the CNBC-TV18 app from the Apple Store or the Google Play Store, or just scan the QR code that's up for you on the screen.
128 points on the Nifty, 500 points higher on the mid-cap index. The Nifty Bank, an underperformer right now, but nothing really to worry about as far as the frontline indices are concerned. BEL continues to do well. And pharmaceutical stocks, for the second day running, they're feeling good. Devi's Lab, Dr. Reddy's, a bunch of them up and about. Let's talk about Gail, though. The company reported a steady set of earnings in the fourth quarter, 13.5% jump in the EBITDA. Our colleague Sapna Das caught up with the chairman and managing director of the company, spoke about the APM gas allocation and how that's affecting the company. Listen in.
APM gas, as far as we are concerned, we are only distributor of that APM gas that is allocated to us from the upstream producers. But since we already have CGD business and we have taken a lot of CGD entities besides Gail's own CGD, so any reduction in allocation of APM gas definitely affects our profitability as far as CGD business is concerned. Now, for our own purpose as well as for CGD companies, which are our group companies or otherwise, whoever wants to have more RLNG because of this reduction of APM, we are extending due support in sourcing that RLNG to all the entities. But yes, profitability-wise, we do lose out because of our CGD business.
So any impact that you saw in your just announced results?
The allocation, the revision in allocation happened in the fag end of the financial year. So the impact will come in the next year, yes.
Or probably in Q1?
Yes, in Q1 also, definitely, yes.
I would also like to understand that, petrochem business, the EBIT has turned negative again. So can we expect a positive margin sometime in the first quarter of FY26?
Again, the prices are not in our hands and it's largely a factor of international prices of polymers, which are ruling very bad, in fact, and that is why the results are so. We expect that the petrochemical prices do improve world over, which will give us margin, and we also expect that there should be softness in the natural gas prices, because our feedstock is natural gas only, unlike other places where naphtha is also one of the feedstocks. And we also expect Government of India to put certain tariff protection measures by increasing the import duties so that the cheap sub-quality polymers are not imported in the country.
Okay, so anything specific on that in terms of the import duties? Because right now it seems that the world is going towards zero tariff.
So, yes, while there is a talk of rationalization of taxes everywhere, but we are not asking for any great increase. The present tariff is 7.5%. We believe that it should be raised to, say, a level of 10%. Yeah.
Yeah, absolutely. So this proposal has already gone to the...
No, this is an industry. There has been industry demand for a very long time. Yes.
Okay. You also mentioned about natural gas prices. So what's the outlook given what's happening internationally at the moment, and also how crude has been behaving?
Yeah, it's a very volatile situation and it's very difficult to hazard any guess. But since the crude oil prices have also softened, and because of the increased production and commitment to increase further, I believe the HH prices should also be in the range of $3.5 to $4, at least in the near term. So I do not see any major upset on the price levels of natural gas.
Well, moving on then, government sources say that 25 days of coal stocks are currently available at the pit heads of thermal power plants. Abhimanyu joins us to fill us in with further details. Abhimanyu?
The situation on available coal stocks continues to be comfortable for the government. As per government sources, around 25 days of coal stocks are currently available at pit heads at thermal power plants. Also, government sources added that the government is looking to increase and better the last mile connectivity for transport of coal to different parts of the country. As far as enforcement of the larger scheme for better logistics is concerned, that is already being undertaken, but last mile connectivity is something which the government is working on. Also, the government is working on beneficiation of coal, of increasing the use of washeries to purify coal before transport, to increase the overall efficiency of the transport and logistics system which is used to transport coal. And also, this will possibly increase the efficiency of thermal power plants and will provide them a better perspective as far as calculation and computation of available coal stocks is concerned. Now, last week, there was an interministerial meeting between the Ministries of Power, Coal and New and Renewable Energy, where the ministers took stock of the available situation. Now, the peak demand scenario across the country is varying depending on the climatic condition, on the weather condition. Now, while state-wise projected peaks have already been witnessed due to heat waves in states like Gujarat and Telangana, there also have been states in northern India where the influence of rainfall and thunderstorms have kept power demand in check for a certain period of time. It remains to be seen how the situation is going to pan out with respect to the availability of coal stocks, and also more importantly with respect to local weather conditions which are going to determine the overall demand going forward.
All right, with that, we're out of time on this edition of Chartbusters, but not without the news. There our director who brings the show to you and fires all these wonderful graphics that
Shalini's birthday. Happy birthday, Shalini.
Birthday. Happy birthday, Shalini. Have a great one, and hopefully we'll be better behaved in all the other shows that you roll with us. Thank you so much for watching. Trading Hour comes up next.